What's good, superstars? Back with another video here on money tests. If you're new here, don't forget to subscribe to the channel. We do all kinds of case studies, tests of our money, see what makes money, what doesn't make money, what works, what doesn't work, so you don't have to do it. You can watch vicariously through me. Anyways, this is kind of like a side project beside or alongside my living out of the brokerage account series. If you haven't seen that, there's a entire playlist on my channel. I think we're up to like 8 videos in that series. It's been a lot of fun growing that account in the different ways. As you can see here on this cash flow diagram, this is how we run and cycle our money. And now I'm introducing a little bit of a twist when it comes to the margin side of the account. So just to go through the cash flow quickly, this is how I'm running that account, living out of the brokerage account. I get a paycheck. Part of my paycheck right now, it's not my entire paycheck. I'm not completely living out of the brokerage just yet. I'm still growing the account. Part of the paycheck gets deposited every time I receive a paycheck. 60% of whatever I deposit goes into margin, which is my growth account. So all my growth funds are in there, never selling them. And 40% is going into my high yield account. This is to help cover the margin maintenance, the margin interest, and it's just to help grow that. Like, as you see here, once the TFSA, once the high yield accounts pay some distributions, we recycle them into the TFSA and build that up a little bit, trying to create like a little mini snowball right now, because we are only putting in 40% of our deposit on that side for now, because my goal right now is to increase equity. I want to maintain 50% plus equity, but the more equity I can obtain as I grow this account, the more available for withdrawal, more available to live off of. So right now, a very, very strong growth minded part of that fund right now. So my margin, I'm growing, like I said, and once whatever I put into the margin, 60% growth I put in the margin, let's say I put $1,000 in, I'm going to be paying from $700 to $1,000 worth of bills, depending on what my equity is. If it makes sense and it keeps me above 50% equity, maybe we pay up to 100% of the deposit value. But I think early on it's more wise to pay less, so like 70%, and that's kind of what I'm aiming for early on. Other deposits, if I get gifted some money, if I get promotional bonuses in my Wealthsimple account, any of that extra money that I'm getting that isn't from the paycheck, I'm throwing that into the margin account, but I'm not investing it just yet. Why am I not investing it just yet? I made a video on this a few videos ago. I think it might be 2 videos ago, where I talk about why I'm just paying down the margin right now. I'm not investing it because, again, long-term goal and near-term goal right now, increase equity as fast as possible to be able to live and pay more bills off. So until I get to that 100% of paying bills through the brokerage, I'm living out of the brokerage, I'm going to have to keep increasing the equity. I did start this after I already had a margin account, so I'm kind of transitioning it, and I don't want to sell anything. Any extra money that comes, say I get to like 56, 70, 80, whatever equity, I have extra equity at that point that I can do stuff with. I'm going to be running this new strategy for put credit spreads. This is something that's kind of newer to Wealthsimple, having a multi-leg option. And that's what I'm going to talk about in this video. So if you are new to options, definitely just watch. Do not follow. Do not do anything I'm doing here, because I am also newer to options. But I feel like I have a good grasp on this one, on how this is going to work. And we're doing our first trade in this account to make sure that things go well. We're going to track it. If it doesn't do well, we're going to stop doing it and we're going to change up the strategy. That's just what this is about. It's called testing your money, money tests. It's the name of the channel. Subscribe, by the way, if you haven't already subscribed. I am not a financial advisor. This content is meant for entertainment purposes only. I do not know what I am doing. I am likely making this video in my car. This is another day where I'm making the video in my car. That's why you will see. You might lose your work. Your recent changes haven't been saved because the internet is wonky. I have to load everything before I even get in the car, bring it in the car, and then I talk to you guys while I wait for my daughter to get out of her program. So that is the cash flow section. Boom. We're over to the investing manifesto, which is my Google Sheets document, has all of my stuff. I made a new tab at the bottom here called Put Credit Spreads. Okay. This is what a put credit spread is. It's just a visual. All right. Basically, you're buying and you're selling a put on a stock or ETF or whatever you're doing. In this case, I do have some parameters. My case, again, this is not everybody's case. I'm new to this. We're going to see if this even works. It might not even work. Okay. So like, really, don't copy me. I'm telling you, it's bad decision. But anyway, today I bought and I sold puts on ARM. Why did I do that? Because it's been oversold. The RSI is under 30. These are some indicators. I also looked at where other points of resistance were and support on the charts, fundamentals. Like if I could pull the chart up, I would, but I can't because I'm in my car. But anyway, I ended up selling a put at $108, and I think ARM was trading around 111, 112. So I sold the put at 108, and I'm doing a $5 wide spread where I buy another put $5 below that. So I bought a put back at 103. So if you look at it on this visual, imagine this is the ARM option visual. This line here, the short strike, would be $108, and the long strike would be $103. The stock price right now is somewhere over here. So as long as we finish, and I did it for 2 weeks out, I think it did 19 days, something like that. It would be the Friday in 2 weeks. So right now the price is here, 112. If the price does drop below the $108, it starts to erode how much money I'm going to take from my premium. So I got the premium up front, which is the spread. That's why it's called a put credit spread. It's called a credit spread, meaning I'm taking in money. There's put debit spreads, which would be the other way around. If I were to sell the long and buy the short, I don't know, I wouldn't do that anyway. But for this thing here, I'm just trying to get extra equity in my brokerage account with a minimum amount of investment. So because I did a $5 spread, if anybody knows any trading options and you're trading contracts, a contract is 100 shares. If I do a $5 spread, I'm risking $500. So the max loss here will be $500 minus the premium that I received at the beginning. So in this case, I received around $140 premium. If I start to go below the $108, say that the price is somewhere like 105, 106, then I will start to see that 140 erode to the point where I begin to lose the money, right? So until I get to the max loss, which would be $500 minus that premium that I got, so it would be like $360 would be the risk. So I'm risking 360 to make 140. It's pretty good, in my opinion. It's pretty good rate of return. If I do end up getting away with it and it ends up closing above 100, I seen 108 as a resistance, so I use that as my number, but a little bit higher than $108. But if it does close above that $108, then I walk away with 140 while risking $500 maximum being locked up, right? I have to have $500 for this trade. That's a pretty good rate of return. I'm risking 500. Like, you can do multiple put credit spreads. It's more of a gamble when you're dealing with options. Obviously, you're looking at something on the chart. You see something fundamentally, maybe. You're seeing something technically. You don't know if you have an incline. This is what these types of trades are for. And the beauty is you can make them smaller. You can do a $50 spread. You know, obviously very narrow window for that. But that would be like, if it's 50-cent spread, then you're only risking $50 on one put credit spread. So you can be risking very minimal amounts of money, but again, the less you risk, the less you're going to make. Risk reward, right? So I'm comfortable in this account with what I got available in margin to risk $500 right now. Maybe we'll increase that over time as I get more comfortable, but for now, I'm risking the 500 to make the 140. I had a good feeling about the chart. This chart's been beat up with the AI trade and all that stuff. I'm hoping it hangs out. It doesn't go below $108, and we walk away with 140 in a couple weeks, which is great return. I mean, it's like over 20%. I don't know the exact number, 120 or 22 or 23% maybe, but you guys can check that out. So anyway, that is how a put credit spread works. Again, if we go below, if we get past my 103, which is the strike that I ended up buying it at, so that'd be limiting my risk. That's going to be maximum loss, obviously. And in between, anywhere you can sell, I can close these positions. So I opened a position here, opened a position here. If it comes down to here, it's hanging out here, and okay, I'm going to get a minimal return, but I'm uncomfortable. Maybe the chart changes things up. Maybe there's some news that comes out and I end up in this range somewhere. I could always close the position and not take the max loss. All right. That's the beauty of it. That's the beauty of, but you have to be on top of it if you're doing this. I could always just let it expire and then move on to the next one and take a loss that way too, right? But if you do lose a bunch of these, the loss is always, in this case, more than what the potential gain is. But the hope is that the odds are in my favor. I think the delta for my short strike was 35 and the delta for my long strike was 20. So to lose max, I got to be 80% of the time I'm not going to lose max. 20% of the time, usually that's how the deltas work. It gives you a percentage on what you're going to do. So that is that. I love moving these pictures out the way to show you guys. So this is just like me playing with money and seeing like, hey, how many do I got to get right if I do this every other week to be profitable on a $500 trade? 22 right, 4 wrong, and I will have a $750 spread on a $500 bet. Not a lot of money over the year if I get only 4 wrong. So it's something you got to look at that way. But I'm hoping that my fundamental readings help me to have a way better edge than that. And we'll see how it goes. So this is my first one, my first trade on ARM. Current price is 112. Right now, I guess as it closed above 112. I think it was in the 111s when I bought. So I'm already probably doing pretty well on this trade. And I think if I do end up earning back over time too, if the price goes up, like if I bring this back here, sorry, if the price goes up, this spread will become less costly to close out. If I get to like 80% of what I want, so say I made 140 on the credit spread, and I've already made back 110, I might close it out, take the 110 and redo it earlier than the 2 weeks. It lets me accelerate what I'm doing here, right? So that might be what we end up doing. But anyways, the spread I did, like I told you, 108 to 130. My risk is 500. My reward is 139, which I take up front. So really the risk is not 500 anymore. And the date of expiry is January 9th. The result we're going to track here, and then we're going to have a bank of how much we add. As I get it bigger and bigger, I might increase the amounts that I'm comfortable doing with this, especially if we're playing with house money. So that is it. I just wanted to show you guys my new technique on how I'm going to increase, or hopefully increase, the equity and grow the margin side of the account. Let me know if you guys have any experience with put credit spreads. Do you have any I guess strategies on how you pick them, what you're doing? I told you mine. I'm looking at things that are sold off with good resistance, good support lines, and we'll go there. It's not always going to happen. There's not always going to be one available. You're going to have to do screeners and all those things, and it's just going to be a thing that I build over time, get more comfortable reading charts. But I want to hear from you guys if you do this, if you've ever done this, and if you're incorporating any options into your living out of the brokerage account stuff that you're doing. Guys, I hope you like this one. Smash the thumbs up. Subscribe to the channel. Keep putting money to the test, and we'll see you in the next one. I love you. Bye.